Welcome back to the Stock Market Masterclass. In Part 1, we laid the groundwork, understanding stocks and their role in building wealth. Now, in Part 2, we're diving deeper into how to kickstart your stock market journey step by step. Whether you're starting with $100 or $10,000, this lesson is for you. We'll cover what to do, what to avoid, and how to create your first investment plan. First up, let's understand the market environment. The stock market isn't a gamble. It's a space for ideas and ownership. When you buy a share, you're saying, "I believe in this company's future." But remember, success isn't about luck. It's about knowledge and consistency. That's what this course aims to provide you with. Before you invest, make sure you have 3 essentials ready. First, capital, money you can invest without needing it right away. Second, knowledge, a basic grasp of how markets work. And third, discipline, the patience to avoid chasing quick profits. Even seasoned investors started small, so don't wait for the perfect moment. The best time to start learning is now. Next, let's talk about opening your brokerage account. This is your digital gateway to the stock market. Think of it as your online bank for investing. To get started, choose a reputable broker like Fidelity or Robinhood. Then complete your verification with your ID and banking details. Finally, deposit your starting funds and you're ready to go. Once your account is set up, you can access real-time market data and make your first trades. Remember to choose brokers with low fees and educational tools, not just flashy marketing.
There are different ways to invest in the stock market. Today, let's explore the most common ones. First up, individual stocks. You buy shares of a specific company, like Apple or Tesla. Higher potential returns come with higher risk. Next, we have ETFs, or exchange-traded funds. Think of them as a basket of many stocks combined into one. They're safer for beginners, spreading risk across dozens of companies. Then, there are mutual funds. These are professionally managed collections of investments, perfect for passive, long-term investors. If you're just starting, ETFs are your best friend. They're low-cost, diversified, and easy to manage. Now, let's build your first simple portfolio with $1,000. Consider putting $600 in a broad market ETF like VIO or SPY, which represents the S&P 500. Next, $200 in an international ETF like VXUS for exposure to global markets. Add $100 in a bond ETF for safety and stability, and keep $100 as a cash reserve for flexibility. That's it. You're diversified, balanced, and ready to grow your investments. Over time, you can add individual stocks to personalize your portfolio further. When you place a trade, you'll see 2 main options: a market order or a limit order. A market order buys instantly at the current price, while a limit order buys only when the price hits your chosen level. For beginners, market orders are simpler, but as you gain experience, learn to use limit orders to control your entry prices. Remember, each transaction has a small fee or spread, depending on your broker. Always review before confirming your trades. Before investing in any company, take the time to study it thoroughly. Focus on 3 basic factors: the business model, financial strength, and competitive advantage. Understanding how a company makes money, its profit growth, and what sets it apart is crucial. You can find this information in the company's annual report or on finance websites like Yahoo Finance and Morningstar. So, don't just buy a stock. Make sure you understand what you own. Investing is more about psychology than math. When prices fall, beginners panic, but seasoned investors see opportunity. When prices rise, novices rush in, while pros stay patient. The best investors think long-term, knowing markets fluctuate daily. Over the years, investments grow with the economy. Focus on progress, not perfection. Even small, consistent investments can lead to big results through compounding. Compounding is the magic of money working for you. Invest $200 every month at an 8% return, and in 30 years, you'll have over $300,000. That's the power of time and consistency multiplying your wealth. Compounding rewards those who start early and stay disciplined. Every investor makes mistakes. What matters is learning from them. Avoid these 5 pitfalls from day one. Don't invest money you'll need soon. Don't chase hot tips or viral stocks. Don't panic when markets drop. Don't ignore diversification. Don't try to get rich overnight. Your goal isn't to win every trade. It's to survive long enough for compounding to work its magic. Once you start investing, review your portfolio every 6 months. If one asset grows too large, rebalance it back to your target mix. Reinvest dividends to accelerate growth. Remember, consistency beats cleverness every time.
Your first year as an investor will teach you more than any book ever could. You'll experience a whirlwind of emotions: excitement, fear, doubt, and pride. Keep track of your decisions. Note what worked, what didn't, and why it happened. You're not just building a portfolio, you're cultivating financial discipline. That skill will serve you for a lifetime. Starting in the stock market isn't about luck. It's about patience, learning, and courage. Every great investor, from Warren Buffett to everyday folks, started with one small step: opening that first account, making that first investment. That's where it begins. So take that step. Invest not just in companies, but in your own future. Because in the end, the stock market doesn't reward speed. It rewards those who start and never stop learning.
Welcome back to the Stock Market Masterclass. In Part 1, we explored what the stock market is and why people invest. Now, in Part 2, we're diving into the practical steps to start investing, even if you're a complete beginner. By the end of this session, you'll know how to open an account, choose investments, and manage risk. Let's kick things off with Chapter 1, Understanding Your Purpose. Every investor starts with a goal. What's yours? Is it financial freedom, saving for retirement, or growing your money faster? Whatever it is, define it clearly. Purpose gives direction. Without it, investing can feel like guessing. Clarity is key. Next up, Chapter 2, Getting Ready to Invest. Before you jump in, make sure you have 3 essentials in place. First, an emergency fund. Save at least 3 to 6 months of expenses. Second, eliminate high-interest debt. Those credit card rates can eat into your profits. And finally, have some investment capital ready. Start with what you can afford to leave untouched. Once you have these, you're ready to begin. Now let's move to Chapter 3, Opening a brokerage account. Your brokerage account is your gateway to the stock market. It's where you'll buy, hold, and sell your investments. To get started, choose a trusted online broker like Fidelity or Robinhood. Complete the verification process, ID, address, and bank connection. Then, deposit your initial funds. Even $50 or $100 is a great start. Modern brokers offer zero-commission trading and user-friendly apps. Congratulations on setting up your account. Now, what should you buy? As a beginner, steer clear of chasing random stocks. Start with proven options like ETFs, which hold many stocks in one. For instance, the S&P 500 ETF gives you exposure to America's top 500 companies. Index funds are similar, but often managed automatically, perfect for long-term growth. Consider blue-chip stocks, stable companies like Apple or Microsoft. This strategy spreads your risk and builds a solid foundation. When you place your first trade, you'll encounter 2 types of orders. Market orders buy or sell instantly at the current price. Limit orders execute only when the price hits your chosen level. For beginners, market orders are a good start. As you gain experience, use limit orders to control your entry points. Prices fluctuate constantly due to millions of investors trading in real time. That's normal. Don't let short-term movements shake your confidence. Before investing, understand what you're buying. Here's a quick 3-step research framework. First, look at company fundamentals. What do they do, and how do they make money? Next, check their financial health. Are revenue and profits growing? Finally, consider their long-term outlook. Do they have strong leadership? Use sites like Yahoo Finance or MarketWatch for data. A few minutes of research can save you years of regret. Never put all your money in one stock or industry. Build a diversified portfolio to balance risk and return. For example, 70% in broad market ETFs, 20% in individual stocks, and 10% in bonds. When one area falls, another can rise, protecting your wealth. Diversification doesn't eliminate risk, but it smooths the journey. The biggest secret to success in investing isn't luck, it's consistency. With dollar-cost averaging, you invest the same amount every month, no matter what the market is doing. When prices drop, you buy more shares. When they rise, you buy fewer. Over time, your cost per share averages out, and you avoid the stress of trying to time the market. Even $100 a month can grow into thousands through patience and compounding. Many companies and ETFs pay dividends, small payments to shareholders from profits. Instead of withdrawing them, reinvest your dividends automatically. This turns every payment into more shares, generating even more dividends later. It creates an endless cycle of growth, the simplest way to accelerate your returns. Every investment carries risk. That's part of the process. Markets go up and down, sometimes for reasons beyond logic. Short-term volatility is normal, but long-term growth is consistent. Don't panic during downturns. The biggest profits often follow the toughest times. The most successful investors use discipline, not emotion. Investing is not a one-time act. It's a lifelong habit. Create your plan. Decide how much to invest monthly. Stick with low-cost, diversified ETFs or index funds. Review your portfolio once or twice a year and adjust slowly. This routine builds financial strength quietly, year after year. Your first year in investing will teach you patience. Some months your balance will rise, and others it will fall. But remember, every great investor has felt those same emotions. The difference? They stayed the course. Keep learning, stay consistent, and trust the process. The market rewards persistence, not perfection. Starting in the stock market isn't about timing the perfect moment. It's about deciding that your financial journey begins today. When you invest, you join the world's greatest engine of wealth creation, ownership. You're no longer just a consumer of the economy, you're part of it. So take your first step, open that account, buy your first share, and begin writing your story, and one investment at a time. Because every great investor started right where you are now.